Don't worry, everybody. Today, I'm not going to talk about volatility, those gut-wrenching moments where you open up your statement and see a lower balance. Today, I'm going to talk about the factors that influence why stocks rise over time. Now, there are three key influences on this. One is earnings growth. So companies are in the business of making money and making profit. And if they grow that profit over time, that has a positive influence on the stock price. Number two, dividend yield. This is the amount of profit that goes out to shareholders in the form of a dividend. Again, if this is there, present and growing, it has a positive effect on share prices. Thirdly is a change in valuation. This is a little more difficult to understand, but this is how much investors are willing to pay for those earnings of a company. So imagine today a company that share is trading at $10 and the earnings are $1. Now, if investors decide that that $1 is worth a lot, they might bid up the price of the share to $15. So again, that valuation has risen. If the share price goes down to $5, the valuation has decreased. So let's have a look at the S&P 500, the broad US index, over the last 20 years to get a sense of the influence of each of these things. So here on this chart, on the x-axis, we see time, 2001 all the way to 2021. On the y-axis, we see rate of return, all the way up to 60%, all the way down to minus 50%. What we're going to see is how the index returned over time. So in 2001, the index had a net rate of return of minus 11.9%. But what were each of the influences of those three factors? Dividends, earnings, and change in valuation. The blue bar represents the growth of earnings. And in fact, in 2001, we saw that earnings decreased by 20%. So a large negative effect on the price of shares. But the gold bar, which is the change in valuation, shows us that investors were willing to pay more for those earnings. So that pulled up share prices. And right there in the middle, maybe 1-2%, is the dividend yield. So again, a nice positive effect on share prices. So again, things netted, minus 11.9%, different influences on how we got there. Let's look at 2002 to see how things looked in that year. Again, not a great year, minus 22% net overall, but it's a little bit upside down this year. Here, the change in valuation was severely negative. Investors were not willing to pay for earnings, despite the fact that companies were growing. They were growing their earnings. Let's have a look at the other years. And again, what we see is that some years are good and some years are bad, but there's this constant tug of war between specifically the change in valuation and the growth of the earnings. What is really, really interesting is that when we kind of net this all out and say after 20 years, what was the core influence on the share price? We can see that over 20 years, the S&P 500 rose on average over 9% a year. But the influence on that was twofold. The consistent dividend yield in gray and the growth in earnings in blue. So what that tells us is that the gold bar, the change in valuation, is noise. And we need to shake that off a little bit when things are expensive or things really cheap. What we need to do is invest in companies that have consistent growing earnings, and that gives us the greatest chance of seeing our portfolio rise. Thanks very much, everybody, and if you have any questions, let me know.